Week 19 of Aon's Public Affairs podcast was recorded August 12th, 2020.
Hello and welcome to the Aon's Public Affairs podcast. Daniel Serota out of Chicago, Illinois. I'm excited to be joined by Clayton Sasse, Managing Director, U.S. Practice Leader for Aon's Credit Insurance Solution. Clay, welcome to the podcast.
Thanks, Daniel. Great to be here. Thanks for having me.
So, Clay, let's dig in. Trade credit insurance has been a topic that's been hitting D.C. on various levels during this time of COVID. I would be interested in your overview of what is trade credit.
Well, credit insurance is, simply put, receivables insurance. It's one company owes another company money for the exchange of goods or for a loan of some kind, and credit insurance simply backs it up. It steps in and pays the debt if the debtor, the obligor, the company that owes the money, can't pay, mostly because of their insolvency, which is a higher likelihood when we are in recessionary periods or in crisis like we find ourselves now. The history of the product may be kind of interesting to quickly go through to illustrate what it is. It was born out of the period between the two world wars in Europe, when during the Depression, when inflation was so high that it was so important for companies to keep cash. We can all remember from school perhaps a picture of someone pushing a wheelbarrow full of French francs or of Deutschmarks to buy a loaf of bread. So it sort of drives home how precious cash was in those periods. So companies wouldn't extend credit. They wanted cash for their goods because cash was so important to get at that point. And the governments of Europe, facing that crisis at the time, realized that this was a real hindrance to economic activity. Companies weren't trading with each other because they had to hoard their cash. So the governments at that time in Europe, in that in-between war period, created these government schemes to guarantee the obligations of one company to another if it were sold goods on credit terms. And that enabled the commerce to flow. Without credit, things dry up. And so that obviously didn't completely remediate all the problems that were created by the Depression in those days. But that was the intent. And it was a good idea, and it was well received, and it was proliferated across the European business community. And the insurers now, a lot of which that we work with, that are big players in providing credit today, are the privatized descendants of those government schemes that were created in that period. So in that same idea, you can see a sort of public policy impetus for the creation of the thing, and that still exists today. The purpose of the product is to keep companies trading with each other. Companies cannot survive if they have to pay cash in advance for all of their supplies. Every company, the entire economy depends upon credit, on the extension of credit to get goods and services flowing. And in recessionary periods, it's essential that sellers of goods who are called upon to extend credit to keep the economy moving have some support to give them comfort to do it. And so that's the purpose of the product, to step in and cover a default on the extension of credit from one company to another.
So very interesting. And during a time of COVID and kind of when we're in this pandemic, can you talk about the problems that can take fold during this and actually talk a little bit of an example too? I think that would be helpful.
So there are a number of different ways that it's impactful. One way that I think is important to understand is that companies, it's not just that they can't afford to use all their cash to buy supplies for operations. It's that they finance themselves. They borrow money for working capital purposes to fund day-to-day operations. They borrow that money against the receivable base, they collateralize the future payment streams from companies that they've sold to. They use that as collateral, take that to the bank and borrow the money that they need to fund day-to-day operations. So the bank is viewing that collateral and determining what kind of term sheet they should give everyday companies, everyday mom and pop companies, from ExxonMobil down to the Acme Plumbing Company. It's a common form of corporate finance. And the type of funding that they're getting is a function of how sturdy the bank thinks the collateral is. And the collateral is the receivables. The collateral is that company's future cash flow from its customers. So the credit insurance steps in and provides security or guarantees the obligations of those customers to its seller, who is also a borrower, and they bring that insurance, they bring those receivables to the bank to collateralize for their working capital loans, and the insurance helps the bank gain more comfort to provide a better term sheet, to provide a better loan. Now, in this moment of COVID, to your question, and probably analogous to the crisis of 2008 and 9, which I think a lot of people remember, corporate credit dried up very quickly. Credit insurance became very important then to keep loans coming, because banks had to get very austere in that moment in their lending. The insurance was not enhancing the terms they could offer. The insurance was making any kind of terms possible. So now we flash forward to this current moment in which we find ourselves, and it's a similar dynamic that, banks have to be more careful with their capital, but they play an important, utility, a public service to keep these companies and these jobs afloat by providing this corporate finance. But they have to do it in a responsible way. Their loans have to be secured by something that makes sense. And the credit insurance is really important right now against the receivables that are used as collateral for companies to borrow money to keep day-to-day operations going.
And Clay, what does the future of this look like, right? So, we're in COVID, economy's going to start hopefully opening up more and more. And, as we start moving towards kind of the restart and getting things moving, what is the future of trade credit down the road?
Well, it is the future is the past is prologue, I guess, and the future is a static. In some ways, there's a dynamic use of the product, but the core application that I've described in the answers to your previous questions, I think will endure into the future. It's a fundamental tool that's required for companies to extend credit to have the comfort to do it. And as we go into the future, and as we try to, I think one of the keys to coming out of this period that we're in is the ability for, economic activity to start to ramp up again. Companies are going to have to ramp up inventory very quickly. They're going to have to provide or procure supplies, the value of which exceed the cash that they have or the assets that they have to support them. But because they've been closed for so long, or because economic activity has been so slowed down over these months, companies are in a position now where to flip a switch, they're not running at mid-season form, but we need them to go into mid-season form quickly as a society, the economy needs to be ready to turn on and move when the switch is given or when the starting gun goes. And that means they have to ramp up inventory. And that inventory has to be purchased with credit because they don't have any assets or enough assets right now to hit that mid-season form and ramp up their inventory to prepare for that. And so the future of it is a key role to support in the short term is to support that ramping up phase, to get the economy back up and going again, to get companies trading again. It's not just that companies have traditionally required insurance to extend credit, now more than ever, because they're extending credit to companies that are more distressed than they were, a year ago right now. So the need is accentuated. And then beyond the short term, as we go into the long term, the applications of the product, aside from that fundamental core use that we described, the ability to enhance financing and to affect products or projects beyond just those that are collateralized or that are financed by loans that are collateralized by receivables, as the insurance can expand its usage and provide comfort to banks and non-bank lenders to support more and more economic activity 12, 18, 24 months out. So the short term is about getting companies trading again, very analogous to what we talked about in the between war periods. The longer term is innovation that the credit insurers will be called upon to do to provide more types of capacity and more products that can support more complicated types of projects.
Well, and I will tell you, I think Aon is one of the firms that could help with the innovation side of thinking about the long-term side of this. And I'm, interested to see how it is able to be folded out. And look, Clay, thank you so much for joining the podcast today. Extremely topical as the debate in Washington keeps happening to try to help get the economy going. I appreciate your leadership and look forward to continue to work with you on this very important topic.
Me too. I appreciate the time today very much.
Please hit subscribe on Apple Podcasts, Spotify. Give us 5 stars and look forward to seeing you guys soon. Thank you.
This information is a resource for Aon clients and business partners. It is intended to provide general guidance of potential exposures and is not intended to provide legal, regulatory, or medical advice. Due to the dynamic nature of infectious diseases, Aon cannot be held liable for the guidance provided. We encourage listeners to seek additional information from credible sources. Thank you.